next aspect that we want to focus on is tax and the GCC landscape. And that's why our next session is very, very aptly themed, Decoding India's Tax Maze, India's tax benefits for GCC expansion. This session quickly will essentially explore how GCCs can effectively navigate through the country's complex tax environment to unlock the growth opportunities. With a huge round of applause, ladies and gentlemen, let's welcome our speakers for this session. Could I have on stage Mr. Aakash Sharma, Head of TaxCo ANZ, to please join us on stage. And could I also have the moderator of this session, Manisha Gupta, partner at Deloitte India, to please join us. Ladies and gentlemen, could we have a round of applause as we welcome two of our lovely speakers on stage. Manisha, welcome. Floor is all yours.
Good afternoon, everyone. I think I can see half the room expecting this session to be very taxing, so stepping out, but we promise we'll keep this session entertaining. It's going to be different from all what you're hearing in the morning, because if it isn't for an efficient tax administration, all what everybody is talking over here would not be possible, right? So, without much ado, Aakash, I'm going to just jump into some of the questions. You've been the leader of the Tax Center of Excellence at ANZ for now the last 7-8 years. And you've been looking at the global tax operations, compliances of over about 20-odd countries. Typically, one would think that a normal GCC, the kind of operations they do out of India is IT, finance, procurement. But something you've been leading for the last 7-8 years is tax. And you've really grown big over the last 7-8 years. Can you share with us what are the kind of tax processes you in ANZ have brought into India?
Sure. Thanks a lot, Manisha. Thanks for inviting me. So first of all, to start with, I would say we have been talking about GCC and everybody has been speaking about the value chain and everything, right? So tax is something which comes in the leg of the value chain, right? So the way you mentioned, right, most of the GCCs would have already outsourced their finance or accounts payable processes or others, right? Tax is the one which comes as the value chain proposition, right? Because that's the key aspect or a key critical process for any organization at the end of the day. Right? So for us, in terms of what we have done, so we started with indirect tax processes, right? So that was our first one to get all the indirect tax processes for various geographies in India out of the GCC, right? And today we process.
And that's the easiest because it's a transaction.
Correct, right? Because it's more transactional in nature, easy. Right, you do get the talents easily, right? And it is a mixture of accounting plus, so you don't need to really have a pure taxation knowledge. Even somebody with an accounting or something can do that, right? And again, the concept remains the same, right? So irrespective whether it's an input tax credit in India or in the US or a UK and Australia, it still remains the same, right? So that's where we started first. While the rules differ, but at the end of the day, the synopsis remains the same, right? Then it was the transfer pricing, which we picked up, right? So first picking up the easiest one, the indirect tax, then the transfer pricing, because transfer pricing has the most impact, right? And once your GCC is, I would say, grown enough and matured enough, that's the kind of processes when you can pick it up, right? So transfer pricing, where we started looking in terms of the shared cost, the STP models, I would say, in terms of TP paper rollouts, right? And all those things, right? Benchmarking studies being done out of here and some of those items. And then the last leg was the corporate tax, right? Which we started doing the corporate tax returns from most of the countries from here, right? And when we say so, compliances, so we still have the review processes onshore, right? That's where the advisor sits, but at the end of the day, all the compliance activities gets done out of the GCC.
Lovely. So typically one would hear about IT and others. What we are seeing is in a recent survey which Deloitte had done, 43% of the 300 respondents actually mentioned that there's some form of tax global processes done out of India. But typically what we see also is because tax is a natural adjacency to finance, as soon as a finance process is brought into the global captive company, that the tax process are also embedded. Let's move on to another topic. We'll come to the India taxes of a GCC, Aakash. We've all heard that the GCCs today contribute nearly 1% upwards to the GDP. And there's, the GCCs pay about 55,000 to 60,000 in taxes to the government today. But one of the most vexed issues which we see today is that we know that all GCCs are on a cost-plus basis. And there's this huge challenge on what is the right cost-plus markup, and therefore what's the right tax to be paid in India. You again are a mature GCC. You've seen the entire evolution. What's your advice to other taxpayers in terms of managing the taxes efficiently?
Sure. So my personal advice, first of all, I do get a lot of questions that, is the India tax the most complicated across the world? No, that's not right? Most of the countries are complicated, right? It's just that we have made it more complicated in terms of the processes, and I would say it's more on the downstream sides of our processes which makes it more complicated, right? So we being one of the oldest GCCs, I think we have tested our waters in terms of how the taxes in India works, right? Most of the GCCs will be working the way you mentioned is on the cost plus markup, right? So the question comes up, what is the right markup, right? And that is how it defines your revenue, that's how you define your taxes in India, and that's how it grows. I think from that perspective, the regulations in India has not been consistent, to be fair enough, right? Because we don't have consistent markups, right? It depends country to country, it depends processes to processes. We do have a safe harbor policies which are not consistent in nature, right? So transfer pricing has always been a question of debate, I would say, and something which everybody drives, because that's where most of the MNCs will have a tax leakage, because for an example, for India, somebody would say that my markup is 25%, while your onshore company or the country would say, no, it's only 15%, right? Then that 10% becomes double tax, right? And that is important. So basically, in terms of that, my personal suggestion would be what we have tested, that while there are safe harbor laws, right, depending on what is your kind of nature of services you do, right, you can opt for that. But the way I said, the current safe harbor laws doesn't really helps us a lot, right? Because they ranges from what, 17% to 24%, right? Depending from 100 crore entity to 1,000 crore entity. And we know that 100 crore is nowadays very small, right? Somebody are running an office even with 10 people easily crosses 100 crores, right? So the best option for GCCs to, I would say, to cut down on the tax risk is the APAs, right? Whether those APAs are unilaterals or bilaterals, while it's a time-consuming activity and something which government, I think, should be working on in terms of to reduce how much time we really spend, but APAs are the way forward, because that's the only key tool which gives you a certainty at least for next couple of years, right? And that gives you a certainty from both the geographies, whether from India or from the onshore location. So whether it's unilateral or bilateral, while I understand it could be a time-consuming activity, you would involve a lot of paperwork and everything, but then that's the key activity which could give you a good 5 years of at least satisfaction to make sure that you don't have any tax leakages.
Sure. Aakash, India, as you mentioned, we are, the cost plus markups could range anywhere between a 15 to a 20%. You have tax rates, if it's a corporate, of about 25, 26%. If it's an LLP, it goes up to 35%. Vis-a-vis some of the other upcoming GCC locations, like, say, Malaysia, Philippines, Poland, etc., where the cost plus markups could range anywhere between a 5 to a 12%. Given this, what's your advice or what's your message to the government over here in India, given, again, The GCCs are contributing 1% to the GDP, expected to grow to 3.5 by 2030. Are they really killing the goose which is laying the golden eggs?
I would say, Manisha, a very great point, right? And while we talk about made in India and then we talk about the GDPs in India, we need to understand that GCCs play a key crucial role in the GDP of India, right? Not only from the employment perspective, even from the exports perspective, right? While we had an edge till now, I think there are geographies, the way you mentioned, are coming up slowly, right? Whether it could be in form of Sri Lanka also, right? Or else Philippines, certainly Vietnam, Mexico, a bit in Poland, and others, right? While so we have seen our age of terms of how we have been growing, even those countries have been growing up, right? And if we compare at this point of time, at any given point of time, India approximately is around 5 to 6% higher in terms of markup from all these geographies, right? While government says that we don't want to really compare ourselves to those countries, which is good in one aspect, but then we need to understand the value chain perspective, right? The way we are growing, some of those value chain I completely understand could be at a higher markup, but giving a same markup across all activities could be a little challenging for us if we continue with the same stance, because other geographies are not far behind, right? They are just coming up and we just need to be ready for that.
Lastly, I know we are running out of time. You know, one of the things I see from an ANZ perspective, you're still outrunning, from SEZs. Now, we all know that there are no direct tax benefits for GCCs being set up in SEZs. What is the real benefit you're seeing of continuing to operate out of SEZs from an indirect tax perspective?
I would say it's a choice, but apart from choice, I would also say that given we have been in SEZ from a long period of time, right, 15 years now, and moving out of something becomes a difficult thing. But second is also the benefits. While the direct tax benefits are out, right, the indirect tax benefits are huge, right, especially your GST, the customs, right, no customs, no excise duties on all your imports, upfront zero-rated exemptions on GST is a big advantage, right? While I understand that in the GST, in the new GST, I'm saying that the input tax credits will come within 30 days, 60 days, but that's a big challenge, right? And that could become a working capital issue for most of the companies, right? Getting 100% GST exemption, zero-rated GST exemption from the initial aspect helps a lot from that perspective, and that is one of the basic reasons as to why we still continue to be in SEZ. While it has its own advantages, disadvantages, but then, yeah.
Thank you, Aakash, and I'm hoping that the next time we speak and we do a survey of the 300 respondents, I'll have more than 43%, I'll have that 80-90% of the respondents saying they have tax processes in India. Thank you very much.